to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Drew Meredith, welcome back to the Australian Investors Podcast.
Good to be here as always.
It is. I'm
exciting. Big week. Lots happening.
Lots happening. Yeah. What did you have for breakfast?
Cold snap, fried eggs on toast. It's good. Quick
Fried eggs
answer. Sunny side up.
Really?
Yeah.
Do you often go sunny side up, or are you like, how do you do it when you cook it at home? When you cook eggs at home?
If I'm doing this was at home. If it's fried eggs, always sunny side up. I just love the googie. There's a little secret though. I'm not sure if I'm allowed to publicize it on here though.
A Derrimouth family secret. Go on.
No, I can't claim this. Yep. There's a spice that you can buy from Woolworths and Coles that goes incredibly well with eggs. It actually goes incredibly well with everything. So you throw that on top with a bit of garlic aioli, and it's delicious.
Well, what's the spice?
I'm not sure if I can share. I think it's a family secret. No, it's called Everything Eggs.
Really?
Yeah.
Why wouldn't you be able? Is that like a trade secret? Like, why wouldn't you be able to share that with us?
Well, it's, when you go to the is it the Master Food Spice Rack? There's like 50 different spices, and this is like this isn't a single one. This is like a blended one, and I don't think a lot of people know it's there. So, sorry, Woolworths, if it just starts selling out like crazy.
Well, you better get your stocks while they last, people. So you heard it here first.
Like most good things, I think it's primarily garlic. Just generally just add powdered garlic on anything. Delicious.
Okay, yeah.
What did you have for breakfast, more importantly? Protein smoothie.
No, we do this. We get organic veggies. So every week we get organic veggies delivered, and it's from a company called Farmbox. Shout out to Farmbox if you're out there. And I didn't realize, like, we've only been ordering through these guys for a little while, and since we got back from the northern summer. And I didn't realize how disgusting like the fruit and veg is at like the supermarkets. Like,
all right. That's what you were saying.
Oh no. Yeah. But like what I mean by that is like I've been absolutely blown away because when I grew up, we grew up on the farm and all we had was organic fruit and veg. My mum wouldn't let us eat anything other than organic fruit and veg. Even if it cost a bit more, that's what we had to eat. And yeah, and so now that we do that again, I think there's been a massive change in fruit and veg produce in Australia over the past 10 to 15 years. It's become really like industrialized. And if you're lucky enough to get organic fruit boxes and stuff like that, man, like you can just sit there and like eat a tomato. So this morning I had
it's the one thing I cannot stand, fresh tomato.
Really? Well, this tomato is like you kind of bite into it and it's just like you can eat the whole thing. It's incredible. And yeah, I had that on with a bit of Vegemite on sourdough, which is like my thing. So pretty happy about that. But welcome to the Australian Breakfast Podcast. And
there's a new
sign up to
we're trying to go into lifestyle. So
yeah, we're all about, we're broadening our horizons. But anyway, there was a question that came in on the Australian Investors Podcast, and it came in via the link in the show notes, which was fantastic. And naturally, now that I'm at my computer, I've lost it. But basically, it was something like this. It's from Vault Boy, which is a throwback to Fallout 76, which is what we were talking about a little while ago. We had stocks for the apocalypse, I think it was, and we talked about different companies that might be appropriate to hold or investments that you could make in an apocalyptic type scenario. But Vault Boy writes in and says, 2 of the best performing stocks on the SPX, I think they mean the
S&P.
Yep. And the ASX over the last few years have been NVIDIA, sorry, what am I saying? And Pro Medicus, that's PME, respectively. So if you're from the United States, listening or watching, PME, Pro Medicus, is the ticker symbol. It's Australia's best performing company over basically every time horizon. If you had to hold one for 5 years from today without selling, which one would it be and why? So NVIDIA, obviously a big GPU graphics card designer. Pro Medicus, a radiology software that's installed in, like, it's growing throughout the United States in a huge way, with global expansion probably in its next 10 years. Which would you choose and why, Drew?
Man, this is incredibly good timing because I was trying to work out what a GPU was this week.
Oh, welcome.
I'm not that
Welcome to
great.
1990, my friend.
I mean, there's the thing about NVIDIA is it's basically been the biggest driver of returns for most markets for the last 12 or 18 months, but a lot of our clients don't actually understand what the company does. So I've actually started writing an article on it this week. And for a long answer to a short question is NVIDIA all the way. It'd be good to know whether it's NVIDIA or NVIDIA or NVIDIA.
Maybe someone can correct us in the chat. They could say,
is the N silent?
yeah. Well, if it's the end silent, wouldn't it just be video?
Video? Could be. Who knows?
Who knows?
But I
Winston
think
on the show to explain it to us.
I just don't think you can go past it. Like just started reading the wiki page on NVIDIA.
Very reliable.
The story is I don't. Have you got a wiki page? I should set you one up too.
No, you can't
the
these days.
story on NVIDIA is just incredible. Like started in 1999, like any good business or tech company or thereabouts. And it doesn't actually make the chips it designs, so it doesn't. It's fabless. I didn't know what that word was until yesterday.
Did you say fabulous?
Fabulous or fabulous, yes, could be both. Returns have been fabulous, and I think the returns have been like 309,000% since it was listed.
Wow.
But as much as I think there's massive runway still for Pro Medicus in the number of hospitals and everything get into, but it's just on a completely different scale. NVIDIA will probably get caught up in different areas at some point in the next 30 years. But its role in powering AI, supercomputers, ChatGPT, all of these advanced applications, it just makes it absolute no-brainer.
Yeah,
compared
cool.
out of those two.
Yeah. So okay. Yeah, fair enough. Yeah, GPUs, Drew. GPUs.
Can you explain what a GPU is?
Yeah, so the simple definition, or simply the way to think about it, is a CPU is typically linear in the way it processes, like it computes things. So like you put an answer through it, and it goes through. Just imagine like there's one hallway, and the processing happens in that hallway. With a GPU, you have smaller decisions, but thousands of hallways that the kind of the signal can go down. So effectively, you can process thousands of, even more, computing tasks simultaneously, and that's what made them in the 90s really powerful for gaming, because in the early days gaming was quite a new, like in the 90s I'm talking about, gaming was very graphics intensive.
We know the 90s well.
Yeah. Oh yeah. And that's why we get out of bed with a sore back. I think that's the test. You know the 90s if you have a sore back.
Yeah.
And anyway, GPUs are basically able to process large volumes of data. So like, for example, in ChatGPT, which you mentioned, if it just took one signal or one input through a CPU, it could do a really good computation, but it would be far slower because it doesn't have like these multiple channels to process really small decisions that it needs to make. So that's basically the benefit of it. And you're right that fabless, NVIDIA basically relies on other organizations like, say, TSMC from Taiwan to make the chips. And so do organizations like Apple and Microsoft. They all rely, and Samsung to an extent, rely on that.
It's ASML, TSMC.
Yeah, so ASML is a different type of business.
Provides the tech to TSMC, doesn't it? Yeah.
Exactly. So that supplies then the technology for TSMC to use, which is lithography machines. So like the size of a small bus. And they're more like advanced imaging and mirroring systems that allow the chips to be designed in the fab. And the fab produces the chips that NVIDIA is designing. And so there's like this real intense vertical, like supply chain here. But yeah, NVIDIA sits at the front of that. So to answer the question, I think I would go with NVIDIA as a Pro Medicus shareholder. Pro Medicus is up 15,000% in 10 years plus dividends. I would go with NVIDIA simply because it's at a much more reasonable valuation based on its multiple futures. Like, so based on next 12 months earnings per share, which is a better indication than trailing, Pro Medicus is currently trading at 163 times price earnings ratio, NVIDIA is 37 times. But if we go into analyst forecasts, not that they're gods or anything, so let's be realistic. But if we go into analyst forecasts, compound annual growth for the next 2 years from NVIDIA is 70% per annum. So if it's on 37 times price earnings ratio, but the earnings are forecast to go up at 70% and then 70% again, that obviously brings down the forward earnings multiple that you actually pay for this, assuming that the company has reliable and sustainable earnings in its future. Because some companies have long, like you could justify a cyclical business, like say a mining company or a bank, being on a particular multiple based on future earnings, but are those earnings sustainable? I don't know. When you compare that to Pro Medicus, which has a plus 150 price earnings ratio, its forward earnings per share target is, I've coined to analysts, 30% growth. So still blistering growth. Anything above 20% per annum compound.
5% at the moment.
Yeah, it's huge. But I think just on a relative basis, it's NVIDIA.
And I think it's a story of like global versus Aussie shares as well. Like we always talk about global tech or global growth as being significantly higher quality than Australia. And they're both, we're not saying it's a bad company, but you're talking about scale and penetration across the entire world for NVIDIA versus, I mean, it is a global company, but just different level of market.
Yeah, I think most people who understand the Pro Medicus business would know that it's probably going to grow for a very long time.
Yeah.
Just given the nature of its business that locks in contracts like sometimes 10 years. So it's going to keep growing. It just doesn't have the multiple ways of winning. It's not important to every place, every government and every customer in the world. It's just a slightly different business model. It relies on implementations and these types of things in hospitals. So,
one of the
wonderful
interesting,
business.
both awesome businesses. One of the interesting things I think from the financial year, if you looked at like who was the best performing funds, you say global equity funds in Australia for the 24 financial year. It basically was who had more in NVIDIA over the last 12 months. So if you had like the benchmark had 6 or 7, now it probably has 8. If you had 13, you did better than anyone that. So it was all about, and there's probably a story of active management when you're building portfolios. Position sizing within active management or within an ETF is incredibly powerful, and it can go both ways. It can go wrong and right, but that's where your active share and what you're looking for from a fund manager is.
It's interesting because, over the last year, Pro Medicus is up 100%. Wowzers.
Yeah.
NVIDIA is up 156%. That's just from today. So, I mean, that's a monster of a thing when you consider what's the market cap on this bad boy? 2.8 trillion.
So, US?
Yeah.
Yeah.
I just want to make sure is that the right figure? Because my mind's about to be blown. Yes, it is.
So a couple of trillion in the last few years.
Jesus. Anyway, what else is making news this week, Drew? What's making news in the land of economics, let's say?
Rates.
Rates.
It's back. I still haven't made a call this year, have I? After making a call every week.
Wow.
Of 2023.
What is the call?
To be
Jordan Peterson?
No action. I just find it incredibly interesting. Maybe I'll get in trouble for this. Who knows? But like for the last 6 weeks, month, whatever it's been, every single expert, in quotation marks, air quotes, was predicting a rate hike in the meeting next week in August in Australia. But then an inflation result this month came in line with expectations, and everyone's changed their mind that there's not going to be a rate hike anymore. And it just kind of reflects the short termness of the media, or the kind of the lack of not that out there, but less conventional thinkers when it comes to interest rates. So on the positive side, inflation is still falling, down to just under 4% in Australia, and now most are predicting no rate rise in August, and that should mean no more rate rises for probably an extended period of time.
Interesting. What's the old joke? If you laid all of the economists end to end, they still wouldn't reach a consensus.
Well, they're all a consensus, and they're all a consensus wrong. This is the problem with consenses. What's the plural of consensus?
I don't know. Surely someone is an English teacher and listens to the show. But yeah, at the end of the day, I mean, who really trusts what economists have to say to make investment decisions? I definitely don't. I don't
Particularly
know
in the
how
short term.
much weight you put on them.
Basically none. I think you want to have an idea of the general direction of interest rates over 3 years. It doesn't matter what happens in the next quarter, the next month, in our view. And if you're getting it broadly right over a 3-year period, then it just means you won't be overexposed to something that does incredibly badly or incredibly well.
I think that's a good target. Is just if you just kind of like augment your focus when you're building a portfolio to 3 to 5 years, I think you'll tend to have you'll sleep better at night. You'll have better outcomes when it comes to like your portfolio management as well, and you won't turn over your portfolio nearly as much.
No.
There is a good question that's come through also this week, Drew, which I know you didn't get the questions because the Apple notes didn't sync across to you, which I do apologize for Apple's shortcomings. There was a question which was PBH Survivor sent in, and they said that with the high cost of living, I don't have any leftover funds to purchase any financial books to read to continue increasing my knowledge. So I rely on your podcasts. I would say, okay, just as a digression, thank you for sending in the question, but I hope that you learned one thing from the Australian Investors Podcast.
You got a free book
Anyway,
coming your way.
you got a free Andrew Derrimouth book, The Golden Years. And they go on to say,
What to make for breakfast?
They go on to say, my question is there any free articles or readings online or elsewhere that you think are must reads? Yeah, I can jump on this real quick. So you can get books from your library for free. There are apps that allow you to access books and whatever, like digital books from your library for free. You can also go down and hire like books. It's a great thing to do. It supports the library and the community as well. And a lot of the times, if your library doesn't have a book in, you can request it and they'll stock it for you. In the Rask community, which is available 24/7, there is also a tab or a space in there where people share their resources, and that's totally free. You can jump in there and have a look. But if I think about what I like to do when I think about investing and how I can live a better life with money, generally speaking, is I read for knowledge, not for entertainment. I'm not a person that reads fiction books and whatever. And if there are things that I would consider doing for long-term advantage, I would read things that don't change. So try and find the ideas and the strategies and the formulas that don't change. And there are two blogs that kind of speak to this. One is the blog by Morgan Housel. He now writes for the Collaborative Fund. Morgan Housel is the author of The Psychology of Money. So you can read that blog. It's completely free. It's wonderful. And if you go back in time, what you'll realize is that all of the things that he was writing about 5 years ago is still relevant today. Or even if you go back to his Motley Fool days in like 2014 and whatever, that stuff is just as relevant today as it was back then. And that's a sign of someone who thinks that way and wants to snowball their knowledge as well. The other resource that I would highly recommend is the Farnham Street blog, which is just fs.blog. It's written by Shane Parrish, who has appeared on the Rask Network before. And he writes about Charlie Munger's mental models, about how to use better ways of thinking and systems and frameworks. And he's also, both of these gentlemen, Morgan Housel and Shane Parrish, are investors. So they have a bent towards helping you understand the investment world and business, generally speaking. So those are two absolute must reads for me. Couldn't recommend them more highly. Drew?
I just ask Owen, if you're listening online, he's got about 400 books behind him on his desk that I'm sure he'd be more than happy to share.
Actually, one of the books up there is called Insufficient Funds. I haven't read that before.
I just got a copy of Die with Zero. Honestly, I think there's a lot of, some of the Facebook communities and things like that. I think in finance, people are more than happy to share. And it's like a lot of these books are timeless as well. I kind of actually haven't thought about it because we have so many subscriptions through our business. Like I go to MarketWatch for kind of stock news, Bloomberg for basic short-term news. And generally, float. We produce a lot of our own content, so that's probably where our difference is. And we launched
Bloomberg's all right.
Yeah, there are some free parts of that, but that's more of your daily market updates generally. I think anyone that's been involved in finance has a lot of books that they probably won't read again. So it's like join part of a community and start sharing the books that you have with other people. Might be a
like I've got
yeah.
you can't really see it, but I've got Intelligent Investor up there. I'm never reading that again.
No,
Um,
I've tried.
Security Analysis,
Okay.
never reading that again. And anyone who recommends that you read them as a beginner investor is never take their book advice again, because those books, yeah, sure, they're great books.
Everyone recommends you read them though. If you want to go to sleep, read them.
Dumb. Nah,
Yeah.
don't read those. If you're new to investing, read books like
Stock
One
Market
Up on
Opera.
Wall Street. Read books like The Psychology of Money, Barefoot Investor, even Simple Path to Wealth, Magic Formula, Twilight, Harry Potter. Yeah, these types of things that you can get a lot of value from. In other news,
I'll share some blogs anyway that I not on the spot, but maybe you can put in the show notes.
Yeah, sure. Flick them across.
Yeah.
In other news, Spotify change in strategy. Drew writes in the notes for this week. Spotify, obviously the big streaming service for not just audiobooks and podcasts these days, but obviously music is where they started. This is an interesting segue, because if you do have a Spotify premium subscription, you can actually get 15 hours of audiobooks a month for free. So we've spoken about this with Dave Gow, who's come on the show. Dave is an author of Strong Money Australia, which is a fantastic blog for Australian investors seeking financial independence. But he was telling me the other day that he, as an author of the book, which now is an audiobook on Spotify and Audible, he gets, I think it's about 75% more of his, I don't know if he gets like royalties or whatever, comes from Spotify and Audible in comparison to the physical book that people can buy on Amazon. So authors are definitely open to sharing more of their valuable insights through audio means, just like this. Like, I'm not an author, but clearly Drew is. And
you should be.
Is that a turtleneck you got on?
No, it's not a turtleneck.
Okay. But if
I'm not Steve Jobs yet.
More books. Yeah. But you, like, the audio medium for authors is huge as well. So, yeah, Spotify results, Drew. Let's bring it full circle.
I think that, but that's a good segue that you're going back to, which was Amazon and Audible, which is, our book is something like $35, I think.
Wow.
But it's not selling for that in many places, but it's actually selling quite a few copies. Not platinum,
really?
Not platinum, but yeah.
Wow.
We're not getting a $3 royalty came through.
Oh, wow. Jeez. Take that to the bank.
No, it didn't. But we filled out a form just in case there's royalties. But Audible is like this entry point. I think it's I was just looking at mine, like $12 a month, and I think it's 2 credits a month. So it's not reading a physical book, but it might be a more approachable way for the cost of like 4 books a year. You can get 10, 12 books. And if you're in your car all the time or walking or sick of listening to us, it's a good way to consume and keep your knowledge going. But Spotify, I think we remember, was it 3 or 4 years ago when Spotify went out there and thought, probably like Disney, they need to go and own all the content that they're going to put on there. They bought I think they bought Kim Kardashian, they bought Princess Harry and Meghan's podcast, they bought Joe Rogan, like these massive figures to get these almost exclusive content on the podcast, and it didn't really work. Probably like all these groups, I'm not sure if Netflix was going that hard on original content, but they've kind of pivoted a lot, and surprisingly seen some pretty good jumps in active users. So they were saying it was up 14% to 626 million for the quarter, in a probably positive sign for us, I guess, as fellow people on Spotify, whether that counts. But
shout out to anyone that listens on Spotify.
Yeah, it's clearly driving sales, revenue's improving, and it's just this, and obviously adding new subscription tiers at the same time. But this, seeing all these businesses change direction, some are going towards AI, and a company like this is going away from original content to just sharing content. So I thought that was quite a unique takeaway, and I think their stock did pretty well as a result.
Do you think, Drew, if I forced you to think 10 years ahead from now, you know how, like, if we bring this back to, like, your eggs on toast or whatever you're eating, you know how people now eat food and a lot of it's just, like, totally, like, modified for your taste buds, like, it's been fine-tuned, like, scientifically tested.
Like everything eggs.
Yeah, like there's so many different types of bacon in the United States, right? And all of them are just it's probably so far away from bacon, it's not actually made from any bacon-related things. Do you think that if we take AI and, like, music and podcasting and these types of things, do you think 10 years from now, people will have adopted just AI-created tunes and AI-created songs and AI-created podcasts, like, build your own
Um,
podcast, build your own music kind of thing?
I feel like AI is already in music. Like I've heard things like
Auto-tune.
on we need a little bit of that. I think like some of the beats, apparently there's like a certain algorithm that the beats. I mean, I'm only saying
Here we
this because
go.
I'm wearing a turtleneck today, but but there are certain like parts of a bass and beats that can contribute to like a hit song. I can see a lot of music being driven and kind of not controlled but improved or converting to AI. I think it's very difficult for podcasts, particularly
Mm,
on more personal topics.
yeah.
You'd lose the banter in there, and the
Mm,
AI is not going to wear a turtleneck and
yeah.
or
Well, no, you
a
never know.
scratchy jacket.
If Elon has anything to say, he might have, like, the Primus thing just sitting here talking to you.
Yeah.
Who knows?
Because it's the ad lib stuff that probably is the most valuable,
Yeah, well,
in my humble opinion.
shout out to everyone at the Waddle Partners event.
Yeah.
There, I did receive maybe 1 or 2 comments who shall remain nameless that did say we're actually funny, Drew. So
We
who
were
would have
actually
thought?
funny. Yeah,
Yeah,
that's
yeah,
good. I'll
they
take that.
actually laugh when they listen to
Yeah.
the podcast, which is exactly what we want when we're talking about finance, because then we know you're not taking us seriously. So there is a question that's come through from Pablo, and there is a bit of discussion just going on live here, so we'll get to that. But if we do answer questions as it relates to serious investing matters, just remember we don't know your personal circumstances, your needs, goals, or objectives. So speak with a licensed financial planner, like say Drew here and the team at Waddle Partners, if you need personalized financial advice. If we talk about investments like ETFs, super funds, whatever, be sure to read the product disclosure statement or target market determination TMD. They're available on the issuer's website, so the super funds website, for example. So go and check those out before you act on any information you hear in a Rask podcast. So we did get a question sent through. It's from Dixie, following up from last week. What would you choose, IVV or VGS or qual? We did talk about IVV and VGS last week, and then has said, have we talked about this? Last week we did say, I went back and listened to this. You said that you would go with VGS, and I said I would go with IVV to be more kind of like targeted, but at the same time still diversified. Let's let's let VanEck enter the room. VanEck with its Qual ETF, QUAL is the ticker symbol. It's the MSCI International Share Quality Shares Index ETF. So it just literally scrapes the world and tries to find big companies from the world's marketplace or stock markets and filter them for quality, which is what we call a fundamental factor. So this would be like high return on equity, consistent profits, that type of thing. It just targets those companies. It's about 300 stocks in the portfolio, Drew. So would you consider that a core position? Would you just disregard it completely? Would it go in the satellite? Would you consider it comparable to IVV and VGS? I'm curious how you think about that.
I mean, what you really look at here is a ETF that invests in the MSCI and probably excludes banking and mining or energy, because that's where most of the leverage and the cyclicals come from, and they're not usually aligned with quality. I think, in my view, we probably more view qual not within the core, but as an important part of the satellite, and it's more around its ability to provide that factor exposure, for lack of a better word. So you're going a certain type of business and you expect certain type of conditions to support quality. Interestingly, and kind of challenge you have of anyone building a portfolio is there's so much overlap between qual, IVV, and VGS. You could say the S&P is almost a quality index by itself.
Mm.
And it's like, for you look at the holdings, and I think as a satellite it makes sense, but as a core, less so. And a big part of that is the cost. So it's 40 basis points, which makes sense if you're adding a quality tactical weighting or a long-term weighting to quality. But when you can buy the S&P at 5 basis points or thereabouts, or VGS, I think it's kind of difficult to justify in your core.
Yeah, agreed. So,
but
yeah,
not a bad product. I mean, NVIDIA, Apple, Meta, Microsoft, top 4 holdings.
I was going to ask you. I was going to give you a pop quiz of what's the biggest stock, because it's NVIDIA inside the qual ETF. So I agree with you. There is a little bit of differentiation in the top 10 holdings, but for the most part, qual has significant overlap to IVV. 76% of the portfolio is US, which is very similar to VGS, the ETF. So VGS, for those of you that are just tuning in for the first time, is a global shares ETF. IVV is the top 500, and qual is the top 300 globally, from like all around the world, but with a quality filter on it. So it just kind of passes out all the other crap stuff, which ultimately leads itself towards a portfolio that, like you said, has a lot of technology companies, a lot of healthcare companies, because they tend to be more wide profit margins, growing sales, that type of stuff, which is a quality metric.
And you can't get turnover numbers for these either, can you?
You can. Depends on your data source. So if you use things like Morningstar, you can often get data for this. Like if you have a Morningstar subscription, sometimes it's on the free website as well. Sometimes the ETF providers do provide turnover.
Because someone
in their fact sheets.
Pablo in the questions is saying IVV has 4 distributions versus qual, which has 1, and that's usually by virtue of the turnover and the rebalancing within the ETF, for not necessarily income, because most of these products don't pay a lot of income anyway.
Yeah, so depending on the rebalance date will also crystallize tax. So some of the active funds do once a year, simply because they're still turning over the portfolio, but they don't distribute the gains that are held up inside of the ETF vehicle. So active funds will hold on to their capital gains and the tax and the income that they receive until they have to legally distribute it. So that's one thing to keep in mind. I think like qual could be used if you blend it in the satellite of a portfolio, but just know that you're effectively just pushing more of your portfolio towards Apple, NVIDIA, these types of things. That's a good point there. So there was a similar question that came through from I Am Rich, LOL. Good YouTube handle. I think I asked this a while back via Spotify comments. Spotify comments. Yeah. But I'll ask here as you're live.
Most of the listeners are on Apple, aren't they?
Yeah, to be honest, Rich, I am Rich. It's probably 80% of our listener base at Rask across all podcasts on Apple. There's probably the anomaly is our business podcast, the Australian business podcast. Surprisingly, that skews younger, and we probably have about 40%, 50% on Spotify, which is very odd compared to the rest of them. So you say, mate, why should I buy an ASX listed ETF just because I'm in Australia? I always hear people recommend buying the ASX version, but they never give an actual reason as to why. One of the biggest reasons, Rich, with this is the simplicity. So if you get an Australian one, it's in Australian dollars, first of all, which is pretty easy. There's no currency conversion. So a lot of the time people say that it's cheaper to buy the US version of an ETF. For example, IVV is the Australian version, but all that does is invest in the US version. But a lot of the brokerage platforms like get you by the short and curlies if you transfer money from your Australian dollar brokerage account to your US dollar brokerage account, which completely smashes any of the fee savings you would get. Secondly is tax. You expose yourself to weird US taxes if you invest in a US domiciled ETF from Australia. You got to fill out your W8 Ben form every 3 years. Tax withholding from US companies is pretty high as well. That's why you got the W8 Ben form. You also expose yourself to estate and death taxes if you are a non-resident of the United States. So the short answer is it's actually a no-brainer to use Australian ETFs. It's not necessarily a bad thing that people invest in the US. I think it's wonderful, but through ETFs, you just simply don't need them.
I think it's, for us, it's all about kind of leakage and friction. Like, there's a lot of
Good point.
friction buying US ETFs via an Australian platform, even a US, or there's just time consuming, and then leakage. There's just cost leakage everywhere. Currency
Mm,
transfers, you're losing a cut. Brokerage, you're losing a cut. When there's probably some very niche areas you might need to, but given if you're just building a core or even a satellite of a portfolio, I think there's 200 ETFs or more now in Australia,
300,
300
over
ETFs now
300.
in Australia.
Yeah.
There's like plenty to choose from. It's only if you want to go super niche that it
Yeah.
becomes beneficial.
And like people like you, like financial advisors, you guys obviously have access to platforms that then have all active funds,
Overseas.
but also unlisted funds, as well as direct stocks. So
Yeah.
you guys have like significantly more menu than the rest of us that mostly just use our brokerage accounts. Um, and yeah, I think that like I'm still keen to buy US stocks, like as an individual stock and have fun in my satellite. But for ETFs and real money, nah. Like it's just not worth the hassle, the risk, the tax, all that mumbo jumbo that comes with having overseas investments. I just do it through an ETF. It just makes so much sense. And by the way, just as a reminder to everyone, just because you invest in an ASX listed ETF, it does not mean that it's an Australian ETF for tax reasons. There are still some, like the VTS ETF from Vanguard, that is US domiciled, which means that for all intents and purposes, it's still a taxable entity in the US. It just happens to be available on the ASX. So that's why we don't use that ETF. It's not the only reason, but one of the big reasons we don't use that ETF at Rask. He says, thanks for answering. But I actually meant an Australian ETF, as in only Australian companies within the basket of shares versus buying something like IBV, which is US equities. Hope that clarifies. Yes, it does, my friend. So why would someone just buy Aussie shares versus US shares? This is actually a phenomenon that's not unique to Australia. Everywhere you go in the world, there's something called home country bias. People think that this is just an Australian thing. It is definitely not. People in the United States tend to over allocate to US shares. People in Canada tend to over allocate to Canadian stocks, UK, Japan. It's the same all around the world. It's more pronounced in Australia sometimes because we have franking credits here in Australia, which is a big draw card for retirees and super funds. So why would you invest overseas when the one thing you need is income and you get a free tax-free kick here as well?
And there's a fundamental benefit. I mean, if you look at Australia, there's been some pretty good videos on it. We've got some pretty good oligopolies and monopolies that you can
Yeah.
invest in here. CBA, I just wrote an article about CBA this week too. Everyone's talking about CBA being the most expensive bank in the world, but it is because it has such a small market, it has a government guarantee, and such strong deposit. Like, there are some really good quality companies in Australia. So it's not like completely forget about them.
Hmm.
And you get a free kick of about 1.5% or 2% in franking credits that are refunded or used to offset tax. So that's why some people, and that's why it should be part of, I think, any portfolio. But then naturally, you might be able to engage with your iPhone or your Apple Watch, but people drive past Woolworths every day. They go to Bunnings every weekend. They relate to the companies that they're living around, and that'd be the same in the US.
Hmm.
That would be a key driver of why people feel more comfortable, and a big part of investing is feeling comfortable and engaging with your investments.
Do you when was the last time you went into a Home Depot?
Never.
There you go.
I don't think
So
so. Yeah.
that's the US equivalent of Bunnings for folks that aren't familiar. Bunnings being owned by Wesfarmers here in Australia. Um, for all intents and purposes, Home Depot is a better business than Bunnings.
Yeah.
But when was the last time anyone went into one? So it would be natural to assume that people would have a home country bias. They're familiar with something. Like if you're a retiree and you're familiar with Australian companies and Australian taxation law and Australian regulation and our politics, and you probably look at any foreign company and be like, a country and be like, whoa, I'm not going to risk my life savings investing too much over there.
Yeah.
Younger people tend to have a bit more of a, I would guess, trusting, I think it's fair to say trusting, or just maybe naivety about them when it comes to investing in anything everywhere, like crypto, like who knows, right? But the reality is, like, as your portfolio gets bigger, you do pay attention to things like, oh, you can get a holder identification number in Australia. You can't get that overseas. So I'll go with a HIN-based model or a CHESS-sponsored broker. I can get franking credits if I invest in Australian companies because only Aussies can get that. Oh, well, I'll do that, Just the things that you probably take for granted. There are some real superpowers that we have here, so that makes sense. But ETFs are the best way to expose yourself to global investing from Australia. So, I remember before, all like the really modern, sleek brokerage accounts came out about 10 years ago. No one really invested in direct stocks overseas. I think it was about 6 or 7% according to ASX data. So now it's much more pronounced. Other news this week: Microsoft sells, says Drew. Buy Apple. What say you, Drew?
I actually don't mind both, to be honest.
Ah,
I think you're in the office and we were bantering about this. Revenue. The headline said, what's 1% cost? $212 billion. I think was the number that everyone was saying how Apple got sold off when Microsoft got sold off when it reported. I think it fell 1%, but it lost $200 billion in valuation on that day. And this is, I think we talked about overseas markets being overvalued because they were pricing in so much earnings growth, but these companies are still growing at a pretty serious clip compared to pretty much everything else in the world. So total revenue for Microsoft was up 15% year on year for that quarter.
wow.
That's still pretty significant for such a massive company. People are more concerned about investment they're having to make. So AI is fantastic, but when you have to add more computing power and add more and more capital to support the AI that everyone's trying to adopt, you're going to have this period similar to what Amazon did for 30 years, which is you're giving up some short-term profit with the hope of getting long-term gains. And the big shock for Microsoft was you've heard it here: slowing growth in their Azure cloud platform. Hopefully I'm pronouncing that right. Growth
Azure,
slowed.
that's right.
Azure.
Yep.
Growth slowed from 31% for the quarter to 29% for the quarter.
Oh,
it was shocking. I mean, I don't know anything.
Where can you get growth
at
these days
30%.
if not $3 trillion companies?
I mean, it probably looks better at Microsoft than it does at Apple, though. Did you take a look at the Apple result overnight?
Tell us more, mate.
And the market tanked overnight, didn't it? Was the NASDAQ down 4%?
Yeah. I think the S&P was only down about 1.6 from memory.
Oh, that's the Nikkei. Sorry.
The Nikkei,
Nikkei's down 5. The NASDAQ
very different country.
Down live. They must be increasing rates over there. No, the NASDAQ was only down 2%.
Yeah, I was going to say.
So this is like the week that all the big tech companies were going to deliver, and it seems like none of them have done incredibly badly. Like Meta came out, sales, revenue, everything, even new users were pretty good.
Yeah, users are good.
Yeah, we're growing much more than expected, given how much they've already penetrated. Apple, it just looks like it looks like Woolworths.
Apple. Okay, here you go, Drew. 5-year time horizon. You chose CBA over VAS the other week, which was
well, it's paying off already, isn't it?
Yeah, well, it is. Okay, 10-year view. Apple or CBA shares? Which one do you buy?
Apple.
Can't sell. Apple.
Yeah. Are you taking a note with Siri on these?
No,
it should be.
She's over there.
Someone will remember. Someone out there.
But so you would take CBA? Would you take Apple over CBA?
Yeah, and CBA over VAS. I don't know what that tells you.
That tells me that Apple's way better than VAS.
Yeah,
in your opinion.
Fair enough.
Yep. Okay. So, right. Okay.
Apple sales up 5%. That's why I'm referring to Woolworths.
Apple is a beast.
Yeah.
Would you take Apple over Amazon?
At this point,
I
almost think Amazon.
Yeah.
Isn't that crazy?
Amazon.
Yeah.
Yeah. There's a lot more leverage left in Amazon, I think, than there is in Apple.
But then Apple will come up with some, new, iHat or something.
Maybe
some
maybe
kind of new technology. Maybe that's
right
Apple. Who knows? With tracking in it, who knows?
Yeah. but yeah, it's interesting because partnerships between OpenAI and Apple could be really interesting because it could force. So in Apple's lingo, they have something called a super cycle, which is where people upgrade their iPhones, their Macs, their everything.
Yeah.
And there's been less, I guess, impetus for people to get a new Apple device in the last couple of years because there's been no I guess, quantum shifts in what you get from a new iPhone versus one that's like a year or two old. And so the super cycle has been, in my opinion, extending. But if they did have a proper AI assistant, which is going to use open AI technology, and I think it's available from the next iOS or the next iPhone that's coming out from September, you would go to that device if you had the choice. Like, why would you not go to a better device that has huge productivity and assistance? So that could force another like squeeze out of the lemon. I don't want to sound like I'm super down on Apple. They have definitely the best TV shows that I've seen in recent times. I mean, come
Definitely
on.
have to agree. Presumed
Yeah.
Innocent,
Oh, yeah, that was good. There's been heaps of different
Ted Lasso.
Ted Lasso. Yeah. So many good shows on Apple TV. But anyway, I think this might sound controversial, Drew, but I might actually take CBA over Apple. Even though I think CBA is not a good investment at this level, I would, I just given all the virtues of its basic monopoly, um, I would probably take it with you, franking credits. I know I'm going out on a limb here, but I would take VAS before either of them. So there's that. We're
We
completely
could
opposite.
do some sort of chart that shows what our bets are against each other. Not
Yeah,
no
we're
betting. Don't
basically
encourage betting.
opposites. Don't bet.
So Apple over versus your CBA, or my CBA versus your VAS. All right.
Yeah,
For everyone
basically
playing along.
VAS CBA Apple, and you're the other way around. You're Apple CBA VAS.
Yeah.
So I think time will tell. But yeah, it's hard to know when you're wrong or really, Drew. So Mickey Mouse is better than Donald Duck writes in and says, "Hello, Owen and Drew. Can I work out previous PE ratios from financials? The only way I can see is by using EPS and then looking at a chart to get the share price chart for that particular year. Thank you for your podcast." Yeah, Donald Duck, Mickey Mouse, however you go. Yeah, you can use the price earnings ratio. You could calculate yourself just using a share price and the earnings per share for that year. But an easier way to do it and avoid anything like that is just to use something for free, like Morningstar. I
Yeah.
think has the ability to do it, but so does the Ticker Terminal, which is my preferred tool. It's only about $20 US a month or $25 US a month. I think 300,000 people now use Ticker. I remember when it came out and speaking to the founders, and I was like, "You guys got onto something really cool here, and we're going to partner with them." But now they're massive, which is awesome. So Ticker TIKR.com. Great tool, wonderful tool. I think they offer a free trial, so it'll calculate everything for you instantly. So I would use that instead. Okay, so there was a question that come through. Maybe I'll wait to tee this one up, Drew. Finally, Amazon results.
Amazon results, yes. It does look like they're taking a bit of a turn back towards the old Jeff Bezos days. So if you remember, Amazon basically gave up on profit. It was one of the first companies it just broke the model that you had to maximize short-term quarterly profits. So they
Yeah.
just chased revenue growth for 25, 30 years, kept reinventing, and as the letter says, had an obsession with making sure they were always giving the customer exactly what they wanted. That said, the share price got smashed, didn't it?
But
Um,
actually, I was just thinking
kind
about
of
you
on that
interpreting
turnaround,
share prices. If
7%.
you woke up today and you were like, "Oh my gosh, the Nasdaq's down," not realizing it's the Nikkei, like,
It's my
what?
eyes. It's
So,
close. I mean, Amazon's down about 10% when
mhm,
it was down to 6% in after hours trading. I would love to
mhm.
understand how after hours trading works at some point too, and down 2% on the market as well. But basically, it's got this. It did see pretty solid growth. I mean, this is the interesting part. It grew slower than Azure did, but Azure was seen as a disappointment. So Amazon Web Services revenue was up 20%. Obviously, a key part of their business.
It's a monster though.
Yeah, similar to Apple, growth's headline sales growth. Apple was about 5%. Similar to Woolworths. Um, Amazon was 8 to 11%, or they're predicting 8 to 11%. So it's not this incredible, massive turnover, but that happens as you get bigger and bigger, and everything you try and do doesn't really move the dial. Or 10% for the year, but it's predicting anywhere from 8 to 11 going forward. It did post a pretty good profit for the quarter, but as far as they're concerned, they're going to be increasing their investment in AI, probably spending more money at NVIDIA, just to keep up with demand for cloud computing and cloud support. Amazon does a lot of work with governments too.
Yeah.
So they're once again investing a lot, doing a lot of capex to get ahead and hopefully extract big profits, 5, 10, 15 years from now, and ride this AI story as well. So it's down about 10%. I think Amazon's basically the biggest driver of the volatility in the NASDAQ overnight, and the Nikkei.
AWS is a beast. So even to grow at 20% is huge. Like,
Yeah,
what did it do just in the quarter?
26 billion.
26 billion. So
that's the market cap of
a lot of companies.
Amcor.
Let's say that. Amcor. Very similar to Amazon in the name. Just buy everything that starts with A.
That's more than the market cap of Amcor. I drive past the old paper mill every day. So.
Oh, right, okay. Amazon makes books. It's the same thing. So yeah, interesting. Yeah, wonderful business operating at scale. It's hugely customer centric. Probably second in my list of quality. Oh, it probably goes Apple TV in terms of quality for streaming. Then it goes Disney. Well, you could fight for those two, and then Amazon Prime Video in third. Netflix is a distant fourth. It's a bit of a mixed bag, to be honest. We will finish with one more question over there, but there was a question here from Stocks Intake on YouTube. It said, would you consider undervalued companies like PayPal? Personally, I would consider anything that's undervalued to be interesting. But a lot of I owned PayPal for years, but I always knew that there was a reckoning coming, because when you think about businesses like Stripe or PayPal, Stripe's done a better job at positioning itself as kind of like a white label provider, whereas PayPal, being early days eBay connection, was always leaning heavily into the PayPal brand means something, and the PayPal trust of the early internet was there. But as time's gone on, people have familiarized themselves with payments on the internet, and Stripe has done a better job of being a white label provider to other payment gateways. The thing that happens is that at the end of the day, in any business, you need to understand who has power in that relationship. So there's a mental, or not a mental tool, there's an actual tool you can use called the Porter's 5 Forces model, which gets you to consider a business from the perspective of 5 different angles. So you've got like supplier power, customer powers, all different types, industry power, market dynamics, and you've got to consider all of the different influences on that business's competitive position in order to understand who has true power. And when you look at a business like PayPal, the obvious thing is, obviously customers don't have power. Like, I can't tell PayPal to lower its prices. I'm not significant in the grand scheme of their business. But who is powerful in that business? Visa and MasterCard. And Visa and MasterCard are the rails for payments in the world. And so sooner or later, like, it could be 5 years, it could be 5 months, it could be who knows how long. Sooner or later, the company with the biggest competitive position will flex its muscles in some way. And that can have ripple effects for other businesses. So as long as that's considered, you've got to understand why companies may be undervalued, quote unquote. You can make a more informed decision. Okay, so Drew, there was a question that came through about someone. They said they've maxed out this. This is a good one for you, Waddle Partners, Drew Meredith. There was a question that came through. They said that they've paid off their home. They're doing really well, and they've realized that they're saving about 50 grand a year leading into retirement. So let's say they're 10 or 15 years. I won't give you too much of the situation because it's general advice. They're about 10 or 15 years out of retirement. They've paid off the mortgage. They've done a really good job. And now they're thinking, well, retirement is, I should start preparing for retirement. I've got about 50 grand a year in savings or long-term investing that was previously eaten up by our mortgage and other things. Now we can do something with it. They've said that they've already maxed out their super contribution of around about 25,000, which should now be higher than that, to be honest, per year. And they do intend to keep working a bit. So that leaves them with about 25 grand a year of surplus capital that they could invest. Just generally speaking, what are the options for people like this when they present to you at Waddle?
This is something we talked about with Tash and Anna during the week as well.
On their podcast?
Yeah. That's Get Rich Slow Club, isn't it?
Yep.
Yeah, sorry. I mean, there's heaps of structures you can use, but ultimately you're putting yourself in a strong position because you've got this savings capacity and now you've got the ability to put it to use. I quoted Paul Clitheroe and said, you put
Oh,
in
Paul.
property, put it in shares, whatever you do, just make sure you're putting it to work. When you've got you don't want to put more into super at the moment because you can't access it till you're 60. You've got options like investing it, in a family trust, investing in your own name, investing in joint names, investing in a partner's name if they're in a lower tax bracket, depending on what's appropriate. But what I'd suggest is you set some sort of regular investment. If that's don't and as we've talked about in the past, don't do it too regularly because your costs start to increase significantly, and make sure you're allocating larger amounts. But just start building that core portfolio that matches up with what's in super and deploying it in this case, probably every 6 months as it builds up to a reasonable amount. And start with your core, and as it gets closer, build towards a more diversified portfolio. But I think a big part of financial advice. Did I just point at myself?
You did, yeah. Which I was just going to go with. But I'm glad someone called
The
it out.
big part of what we do is if you've done the hard work of accumulating savings, the big part of what we do is how do you get most of it into super as you get closer to retirement. Yeah, it does make sense if you're in your 40s and 50s, early 50s, but as you get closer, and there's so many ways to get money into super, and everyone knows the benefit, tax-free once you retire, no tax on the earnings once you retire either. So it's a no-brainer to have that in there then, but you can get that done pretty quickly as you get closer to 60. So don't worry about getting in the right entity, just put it to work.
Yep, cool. I actually caught up with Paul Clitheroe. There's an episode probably coming out this week with Paul.
Excellent.
He's a splendid human being. So final question comes from Calvin. It's here in the chat. Just a question to Owen. I know the Rask Network advocate for long-term sensible investing, recommending index and ETFs with a core satellite. Given the many appealing investment ideas presented, how do you differentiate between those that you are interested in and those that are noise? How
So
do you
why
ensure?
are we gas bagging around
Yeah.
stocks and
How
we
do you
haven't buy
ensure
them?
your own investment decisions align with the objective, sensible approach you advocate for? Well, that's the simple way to think about this, and the way I think about it, Calvin, and I think Drew's similar. You just might call it something different. I think all investing should be core and satellite investing. So you should have a core investment portfolio that's sensible, low cost, and is long-term focused. And it just so happens that should probably, that's not always, but it should probably be heavily skewed towards index or rules-based investments that are lower cost. Why? Because if that's the majority of your money, you obviously want to minimize costs and maximize diversification, while also having an investment approach that could still, imagine you pass away and your wife or your son or your daughter or whoever has to take over your portfolio. What are the keys that you're handing them, and how easy is it for them to manage? For me, this is an anti-fragile way of investing the core portfolio. So I often get asked the question of, if you had 20 years to invest, what would you buy? The easiest answer to that question, if you take Charlie Munger's inversion, is don't try and pick the best investment over 20 years. Just try and pick the one that will still be here. And an index fund is an anti-fragile investment because it evolves with the market. Railroads used to be in the index in the year 1900, but now it's technology companies. So I choose an anti-fragile approach to the core, low-cost, diversified, sensible. And to take a leaf out of Drew's book, don't prepare for a certain future, prepare for any. And then with the satellite component, that's where you can have fun. And when I say you, I mean anyone. Anyone can have fun in the satellite of their portfolio. So, for example, if I was to buy PayPal, it's just a very loose example, that would definitely be in my satellite. It would not be in my core portfolio because it's in a pretty interesting state in terms of the payments market, in terms of its ability to monetize Venmo and its other digital and electronic assets. So it's definitely not something that I would hold with a 10 or 20-year time horizon. It'd be something that I'd be actively monitoring, probably with a 5-year time horizon rather than a 5-month, which is what most people seem to think is long term. And yeah, I think that's how I think about it. And in terms of any investor, like Drew would probably tell you this, is that you should start with the end in mind. Whether you run a business, whether you get into a relationship, whether you create a financial plan, start with the end in mind. Like, what's the end goal? Because if you don't have that end goal, what's the old saying? If you if you don't know where you're going, any path will take you there. And a lot of people end up in this rat race where they save, scrimp and save, and they've got all this money, but they've got no happiness. And that a lot of people do the opposite. They just don't have a plan, so they don't think about it at all until it's too late. So those are just some keywords of wisdom of how you think about that and how that's reflected in a portfolio. Anything to add on that, Drew?
It depends.
A good one.
Apparently, I say it all the time. Who knows? I think the big one. I mean, we're in a different position where we're advising multiple, different families, or 100, 200 different families. And for us, so it's easier for us because we basically have a framework, and we have we build an investment policy for each client, and that sets the framework, which is what your asset allocation is, the types of investment you'll invest into, and that governs the core. For a lot of people, they've saved, they've scrimped, they just want to hand over investment and trust us to make decisions. In that case, you 100% in your core. But where there's people who are engaged, engagement's incredibly important for people to stay connected with their money and their portfolios, and it kind of builds better relationships. So as we're very clear on what the investment policy is for that core, and then if someone wants to invest in 10 small caps, then we'll try and set an investment policy with them around that. So let's make sure the position sizing isn't more than 5% per, have a rule on both that side and on your core for us. And rather than just, we don't want to say yes all the time, and we don't want to say no all the time either. So it's more about yes, but, or no, but is that an appropriate position sizing given your objective over here?
Mm-hmm. And if you do want to get in contact with Drew and the team at Waddle, it's drew@waddlepartners.com.au. If you did get a question on the show today and you do want a free book, Drew's going to give you one. Just making it up on the spot. Send him an email, drew@waddlepartners.com.au, and send him your postal address too. So
feedback and dad jokes welcome. Only positive feedback though.
Do you have a dad joke for us today?
I had to prepare. I was worried about the last minute, so I think this is a winner. There's a bit of singing.
Okay, here we go. And don't forget, if you are on Spotify, YouTube, Apple, one of those other things that people use like Castbox or whatever, just hit subscribe, leave us a review. We've got heaps of free stuff on the Rask community. It's a free online community where we chat 24/7, so go and check that out. There's heaps of links in your show notes as well. Drew, take us off into the sunset. We'll be back next Saturday, but you often leave us with a dad joke. What have you got for us this week, son?
All right. I don't know what this one relates to. I looked for some clothing ones, but they weren't very good around turtlenecks and that sort of thing. So this one. The person who invented the Ferris wheel never met the person who invented the merry-go-round. They traveled in different circles.
Well, you've definitely nailed that one, mate. I'd give you a solid 7 out of 10 for that. So, yeah, mate, you're on fire this week.
Improving.
Well, enjoy that turtleneck. You're giving me, definite Steve Jobs vibes. I'm digging it. So thank you, sir, and thank you for joining me today, and everyone that joined us live for a quick chat. We don't always do it live, but it's great that you joined us on YouTube. So thank you for that. And Drew, bye for now. We'll see you next week.
Good to see you.